Let's be honest. Taxes can feel confusing and stressful. But here's something most people don't realize. You don't need to be rich to use smart tax hacks. Some of the best ways to save money on taxes are right there for everyday people. You just need to know how to use them. So ask yourself, are you tired of giving away too much of your paycheck? Do you want to save more and keep more for your family? Are you ready to stop guessing and start planning smarter? If you said yes, this video is for you. In 2025, with new tax rules on the way, now is the perfect time to take control. We're going to break down the top 3 tax hacks that could help you save big and maybe even start building generational wealth. If this sounds helpful, hit like and subscribe so more people can learn how to protect their money. Let's get started. Hack 1. Real estate tax strategies. One of the easiest and smartest ways to pay less in taxes is by using real estate. It's one of the best ways families can protect and grow their money. Why is that? Because real estate lets you show losses on paper, even if you didn't actually lose any real money. And those paper losses can help lower your tax bill in a big way. So you're keeping more of what you earn, while your property keeps growing in value. It's a win-win. There are 3 main ways people use real estate to reduce taxes. 1. Active participation in real estate. If you make less than $150,000 a year, you can take up to $25,000 in real estate losses off your taxes. But here's the key. These losses aren't real losses, where you lost money. They're called paper losses, mostly from something called depreciation. Let's say you own a rental property. Even if it's making money, you can still claim certain costs and use depreciation to show a loss on paper. That fake loss can then help lower the taxes you pay on your job or business income. And the best part, you don't need to be a full-time real estate investor to get this benefit. As long as you're involved, like keeping an eye on the property or managing the manager, you can qualify. It's a simple way to save money just by owning and managing a rental. 2. Real estate professional status reps. This one's for people who work full-time in real estate, like agents, contractors, builders, or serious investors. If you spend at least 750 hours a year doing real estate work, and it makes up more than half of all the work you do in a year, you could qualify for something big. What's the big deal? Once you qualify, all the losses from your rental properties stop being passive. That means you can use those losses to lower any kind of income, even if you're earning $200,000 a year as a doctor, lawyer, or business manager. And here's the best part. If you're married, only one spouse needs to meet the time rules. So even if one person works a regular job, and the other handles the real estate side, you both still get the full benefit. It's a powerful way to use real estate to cut down your tax bill in a big way. 3. Short-term rentals, Airbnb strategy. This one is a big win, especially for people who make a lot of money but don't qualify as full-time real estate pros. If you run a short-term rental, where guests usually stay less than 7 days, the IRS sees it as a business, not just a regular rental. That's good news, because if you manage the property yourself, or spend enough time on it, you can use the losses from that rental to lower your other income, like your job or business earnings. Let's say you buy a beach house and list it on Airbnb. You only rent it for 3 months, and most people stay around 4 nights. As long as you're doing the work, or meeting the time rules, you can write off things like bonus depreciation and other costs. Even in your first year, that could mean saving tens of thousands on your taxes. You don't have to be a full-time landlord. You just have to use the rules smartly. If this is helping, hit that like button so more people can learn how to protect their money. Hack 2. Owning a business, even a small one. Starting a business isn't just about earning more. It's a smart way to save on taxes. When you run a side hustle, freelance, or help with a family business, you open the door to legal tax write-offs that regular employees can't use. Things like your phone bill, internet, home office, and even some meals or travel can be deducted. These savings add up fast. Even a small business can cut your tax bill by thousands. If you're already doing the work, make it official and start saving. 1. Reimbursing yourself for business expenses. If you work a regular job, you can't write off most of your work expenses anymore. But when you own a business, like an S Corp or C Corp, you get more options. Your business can pay you back for things like your phone bill, internet, part of your home used as an office, supplies, and even meals or travel for work. And the best part, you don't pay tax on that money. It's a simple win-win. The business gets a tax write-off, and you get your money back without owing taxes on it. 2. The Augusta Rule. If you work from home and own a business, here's a smart trick. You can rent your home to your business for meetings, up to 14 days a year. It's called the Augusta Rule. Your business pays you for using your home, and the money you get is tax-free. That means you get paid, don't pay any taxes on it. And your business still gets a write-off. It's a simple and legal way to save more money. 3. Administrative home office. If you have a small business and use part of your home as an office, your business can pay you back for that space. You could write off around 15% to 20% of your home expenses, like your electric bill, internet, property taxes, or even part of your mortgage interest. Regular employees can't do this. But if you own a business, even a small one, you unlock this smart way to save money on taxes. 4. Multiple income streams. One business can do a lot more than you think. You can run your side hustle, manage online sales, handle investments, or even help your family, all under the same company. It keeps things simple and opens the door to more tax savings. Here's a smart tip. Choose the right setup. Businesses like S Corp or C Corp give you more tax benefits than being a sole proprietor. They let you do things like reimbursements, deductions, and even retirement planning the right way. In 2025, people who plan smart with their businesses can save thousands. That's how wealthy families protect their money, by using trusts and businesses together to lower taxes the legal way. Hack 3. Maxing out retirement accounts the smart way. If you're not using retirement plans to lower your taxes, you're leaving money on the table. And we're not just talking about your 401k. Let's break it down. 1. Solo 401k, and employer 401k. If you work a regular job, and also run a side business, here's some good news. You can have more than one 401k. In 2025, you can put in over $23,000 as an employee. But it gets even better. Your business can also add money, bringing the total up to $70,000 per business. Yes, that's right. Up to $70,000 can be saved and grow without paying taxes on it now. And if you own more than one business, you might be able to do this again with each one. This is a great way to save more for retirement and pay less in taxes, all at the same time. 2. Defined benefit plans, aka retirement on steroids. This is where things get serious. A defined benefit plan is like a pension, but for yourself. It uses your current income and future retirement goals to calculate how much you need to save. Let's say you earn $200,000 a year and want to keep that income in retirement. You might need to save $3.5 million. With a defined benefit plan, you could legally put away $200,000 or more each year, all tax deductible. This is how high net worth individuals use estate planning tools to reduce their taxable income today, grow money tax deferred, and plan for a wealthy retirement. Some people even contribute over $1 million per year, using this strategy. The money grows inside the plan, and you only pay tax later, when you take it out during retirement. 3. Health savings accounts, HSAs, are like secret retirement accounts for medical expenses. If you have a high deductible health plan, you can contribute up to $8,550 per family in 2025. Here's why HSAs are special. You get a tax deduction when you put the money in. The money grows tax-free. You pay no tax when you take it out for health expenses. That's called a triple tax advantage. And it's hard to beat. You can even invest the HSA money in stocks or funds, let it grow, and use it years later to pay for healthcare, even for expenses you already paid out of pocket. If you're doing generational wealth planning, HSAs are a great tool to set aside money for future family medical costs. Conclusion: you don't need to know every tax rule to start saving. Just pick one smart move and take action. What's one step you can try today? Could you rent out a property short-term and use bonus depreciation? Maybe start a small business and use the Augusta Rule? Or open a solo 401k and build your retirement while cutting taxes? These aren't tricks. These are real legal strategies that smart families use every day to protect and grow their money. So ask yourself, are you ready to keep more of what you earn? Are you planning for your future or just reacting when taxes hit? Don't wait for tax season. Talk to a tax advisor and make a plan now. If this video helped you keep more of your money, hit that like button, subscribe, and drop a comment with your favorite tax tip. Let's grow wealth smarter together. Until next time, take care and plan smart.